Welcome to the AI for Career Success video overview by Curt Robbins, where we help you get smarter than your competition.
So, let's set the scene. On February 3rd, 2026, a shockwave hit the global software market. In just one day, a massive sell-off erased $300 billion in value. Now, to really understand the gravity of that number, we need to examine the damage to some of the industry's biggest players.
Take a company like SAP, the enterprise software giant. In a single trading session, its market capitalization dropped by $40 billion. Just gone.
And this wasn't an isolated incident. If you look at the legal and data firm Thomson Reuters, their stock took a nosedive of 14%. The impact was incredibly fast, and it was clearly systemic.
Okay, so let's really get into it. What exactly happened on that day? Well, across professional networks like LinkedIn, tech and finance analysts started piecing it together, trying to make sense of a market shock that seemed to come out of nowhere, but, in hindsight, felt almost inevitable.
The sell-off was genuinely global in scale. Here in the US, all three major indexes finished in the red. In India, the Nifty IT index plunged by over 7%. We saw major software companies like Salesforce and Intuit take absolutely devastating hits. The legal tech sector was hammered, and it even spread to private credit firms that had loan exposure to software companies. They saw double-digit drops. This wasn't just some localized panic. It was a fundamental reevaluation of an entire industry.
So, you have to ask, what was the catalyst? What single event could possibly trigger such a deep and widespread market reaction? It wasn't a financial meltdown or some geopolitical crisis. No, it was a product launch.
The trigger was the release of a new AI tool from Anthropic. It was a suite of what some were calling legal plugins, and these were designed to automate really high-value legal work. We're talking about drafting contracts, checking for compliance, preparing briefs, and doing it all right inside a user's normal workflow.
This is a moment that perfectly illustrates the new reality we're in. The launch of just one AI product was enough to spark a multi-billion-dollar reevaluation of the entire software and services industry. And suddenly, the market was forced to confront a pretty terrifying new question.
For years, the guiding mantra in tech was that software is eating the world. But this event introduced a disruptive new idea. What if AI is now eating software?
Analyst Alessandro Donetti really captured the mood perfectly. The fear wasn't about one company or a single product. It was about a fundamental paradigm shift in the technology landscape, a shift that called into question the very foundation of the modern software as a service, or SaaS, business model.
And just look at the contrast here. On the left, we have the old SaaS model, expensive per-seat licenses that locks companies into these costly proprietary systems. But on the right, you see the new AI model, and it just completely flips that script. The cost to build these powerful tools is approaching zero, and it empowers non-technical users to automate complex work themselves. It's a fundamental shift from being a prisoner of software to becoming its master.
This brings us to a really crucial reframing of the whole AI debate. As analyst C.A. Mehta Arnold pointed out, the immediate question for investors isn't really about AI replacing people. It's about whether AI will replace the revenue streams that entire industries have been built on for decades.
Andrew Berman put it much more bluntly, RIP billable hours. And that sentiment really gets to the core fear that the high-margin, service-based economy, from law and consulting to IT services, is now facing an existential threat to its entire pricing model.
So, this disruption points to a much larger economic shift. If value is seemingly evaporating from software and services, where is all that capital going? The market seems to be signaling a completely new value equation.
This slide illustrates what some are now calling the great value transfer. On the left, you can see value evaporating from these infinitely reproducible digital assets like software code. But on the right, that value is re-emerging. It's accruing to the finite physical infrastructure that actually powers AI, things like our power grids, data centers, and physical supply chains.
And we're seeing this play out in real time. On the exact same day the software stocks were crashing, Walmart, a giant of the physical economy, was approaching a $1 trillion market cap. And they were doing it largely by deploying AI to dominate logistics and e-commerce. It suggests the winners might not be the ones selling AI, but the ones using it to master the physical world.
Ultimately, this whole market shock served as a massive wake-up call. It was a clear signal that the old rules for what it takes to succeed in the tech industry are being completely rewritten by AI.
The market's new demands are becoming quite clear. Investors now want to see concrete results from AI, not just lofty promises. They're looking for clear, defensible revenue streams that come directly from AI tools. And most importantly, companies need to demonstrate clear moats, advantages like unique data sets or powerful network effects that an AI model can't just replicate overnight.
To put it simply, the era of funding AI promises is over. The market has now officially entered a new phase, the era of demanding AI profits. Hype is no longer a viable strategy. Tangible value creation is the only thing that's going to matter from here on out.
And this leaves us with a critical question to think about. As AI continues to commoditize complex digital tasks and shift value back towards the physical world, which business models are truly built to last? Thank you for watching. This is where we teach you AI and help you get smarter than your competition. To continue navigating the future of work with us, please subscribe to the AI for Career Success channel. And if you found this breakdown valuable, a like, comment, or share goes a long way in helping other professionals find this content.